The contribution margin reveals the amount of sales revenue House of Coffee will be able to contribute towards fixed cost, and the unit contribution margin reveals the product that would require fewer units to be sold in order to cover fixed costs. Now, we need to use the contribution margin ratio to determine how much money is left as profit after paying fixed costs. The contribution margin ratio allows businesses to calculate the percentage of sales revenues from a specific product that pays for fixed costs and the percentage that's left as the margin or profit. It's essentially the unit contribution margin expressed as a percentage of sales.
Hello, certified professional. If you are enjoying this course, get accredited with CPE credits for watching it. Click the link in the show notes or visit cpeflow.com to access the full course ad-free and pass the final assessment quiz to officially earn your NASBA approved CPE credits and certificate of completion.
So let's take a look at the formula. Contribution margin per unit divided by sales price per unit, and that equals the contribution margin ratio. Businesses usually have a target contribution margin ratio in mind when pricing products and services, and that's because it reveals how much money is left as profit after paying fixed costs. Using total contribution margin, which we'll cover in the next lesson, and the total sales price in the same formula will equal the same contribution margin ratio. Last we spoke to the House of Coffee owner, he was planning to focus on selling the large cappuccino rather than putting so much time and effort into the coffee puff pastry. So let's compare House of Coffee's 3 products and their respective contribution margin ratios. And we can see the results align with the founder's decision. So let's start with its most successful product, the large cappuccino. After all, it's got to be the best one of the bunch, right? We can find the contribution margin ratio of one large cappuccino by dividing House of Coffee's contribution margin per unit, which was $4, by the sales price per unit, which is $7, yielding a contribution margin of 57%. With a 57% contribution margin ratio for a large cappuccino, for every dollar generated by the sale, there is 57 cents that contributes to covering fixed costs and generating profit or margin. Further, if 57% of sales dollars is the contribution margin, then 43% of each sales dollar is used for variable costs. Sales 100% less contribution margin ratio of 57% equals variable cost ratio of 43%. For the large Americano, we divide House of Coffee's contribution margin per unit of $3 by the sales price per unit of $4, which gives us a contribution margin ratio of 75%. A 75% contribution margin ratio means that for every dollar generated by the sale of a large Americano, 75 cents contributes to covering fixed costs and generating profit or margin. That means only 25% of each sales dollar is used for variable cost. That's sales of 100% less contribution margin ratio of 75% equals variable cost ratio of 25%. For the coffee puff pastry, we divide the $2 contribution margin per unit by the sales price per unit of $8, yielding a contribution margin ratio of 25%. With a 25% contribution margin ratio for a coffee puff pastry, for every dollar generated by the sale, there is 25 cents that contributes to covering fixed costs and generating profit, or in other words, margin. That means the remaining 75% of each sales dollar is used for variable costs. That's sales 100% less contribution margin ratio of 25% equals variable cost ratio of 75%. What does it mean for the owner? What this reveals is that while so far the large cappuccino has been the star, House of Coffee's large Americano is the product that has the highest contribution margin ratio. and thus the least amount of sales revenue is going towards its variable cost, 25% variable cost ratio. But before the owner goes all in on putting most efforts into selling the large Americano, let's take a step back. What we've just learned is good information for our CVP analysis, but it should be considered with other factors like the dollar amount of contribution margin. And here is why. If we only use the contribution margin ratio to guide our decision on which product to sell the most of, it would look like it should be the large Americano. But we saw in the comparison for our unit contribution margin that fewer large cappuccinos were needed to be sold than the large Americano to cover fixed costs and realize a profit. So let's not dethrone our large cappuccino just yet. Although contribution margin ratio can be a bit deceiving when solely analyzed, it is an important calculation to know when we learn about break-even analysis and target profits in a later lesson.